The really cool thing about producing content for YouTube is that every once in a while, someone comes into your comments and leaves a remark that really just turns your world upside down in the best way. So, thank you, Felipe. You gave me some really deep and really interesting rabbit holes to go down over the course of this weekend, and I just can't wait to share what I found. But first, a quick disclaimer. I am not a financial advisor, and this is not financial advice. The content in this video is for entertainment and educational purposes only. Past performance is not indicative of future results. Statements made are my opinions. Investing involves risk. Always do your own research. Rather than continuing to run approximations and clever reconstructions, I went digging, and eventually I found a dashboard where SocGen publishes a lot of good stuff about its indices, and particularly the SG Trend Index and the SG CTA Index. And now DBMF is based on the SG CTA Index, and the replication sleeve of RSST is based on the SG Trend Index. And on this dashboard with this chart, you can see all time for these indices. Now, in the glider that you can drag on the chart, it just shows per month. But what I did is I broke out Claude and I investigated the back end of the code that creates this web page and found out that the daily returns are actually accessible through this dashboard, and therefore I was able to download them and put them into a spreadsheet and then upload them to testful.io. So now I have the actual SG CTA index and the actual SG trend index to compare and use in my back tests and funds analysis. And that's going to change some of my prior conclusions. For example, did you know that in testful.io, the prehistory of DBMF before the fund's official inception date is actually just the CGCTA index, but with about a negative 1.65 drag? So adding to the fund to compensate for the removal of fees. I sure didn't. So here on this back test, you can see DBMF Sim, which is a pre-built ticker in testful.io. You can see the SGCTA index, which I downloaded. I ran the back test. You can see that they're pretty far apart, but watch what happens when I enter negative 1.65 to estimate the fee structure. Looky there. So, all the way up until DBMF's actual inception date in 2019, it's an exact match. Exact match. So, testful.io obviously is getting the actual SG CTA index too, and just modifying it with a negative drag to simulate the prehistory of DBMF. But note how much DBMF actually diverges from its index. It's roughly the same shape, but it's pretty high above that red line there. So, really interesting stuff, which I'm about to get into. So, DBMF and RSST, and also RSIT, since RSST and RSIT have the same managed futures sleeve, represent two different ways to replicate managed futures indices. It's not a question of which one is better than the other, they're different. Okay, so we're going to get into what makes them different. Hedge fund indices are always reported net of the constituents' fees, right? So if you can work out what those managers are holding and hold it yourself directly, you keep the fees they were charging in your pocket. Kind of like if you wanted to hold the S&P 500 but you didn't want to pay 3 basis points to Vanguard, you could buy all of the 500 largest companies and size them appropriately, and then just revise on the same annual schedule and look at the uh, fund reports and whatnot. But I mean, who wants to do that just to save 3 basis points, right? Well, managed futures world is a little bit different. Anyway, DBI estimates the market exposures directly from the index return stream and approximates it with about 10 liquid future contracts. Meanwhile, Resolve, which is the company that does RSST and RSIT's replication, it puts 70% of its sleeve into identifying and then running the trend systems that generate the index returns for the SG trend index. And it does this across more than 30 markets. And then 30% it puts into the same method as DBI, but again, with those 30 plus markets instead of just the top 10 most liquid markets that DBI uses. Management fee recapture actually works the same way in both funds, and so it contributes nothing to tracking error, like the big tracking error we saw with DBMF in the back test right before this slideshow. Um, a constant drift has no variance, so management fees that are flat shouldn't have an effect. But incentive fees are a different animal. So incentive fees are convex and path dependent. They add some tracking error. Resolve tracks its target more closely. So RSST and RSIT, their managed futures sleeve is much closer to the SG trend than DBMF is to the SG CTA trend. And it's a pretty sizable difference. I mean, you've got a correlation from the correlation matrix for DBMF to the SG CTA trend at the monthly level of about 0.788. And you've got a correlation between the Resolve Managed Futures sleeve and the SG Trend Index at this monthly level of about 0.880. So that can make a pretty big difference over time. DBMF's much larger return advantage doesn't come from saving on fees. Instead, it comes from the concentrated bet it makes on those 10 to 15 most liquid futures contracts. The other thing that makes a difference between the two funds is their different approach to look back and rebalancing. So, DBI, Dynamic Beta Engine, looks at the trailing 60-day performance of CTA hedge funds and solves for a portfolio of liquid contracts that would have mimicked it, or at least approximated it. Now it's looking at performance, not positions. The output is deliberately small and liquid, which keeps costs and capacity in good shape. Resolve, on the other hand, 30% of its sleeve is top-down elastic net regression fitted over 20 to 40-day windows. The other 70% picks among 13 trend-following systems using ridge regression against the SG trend daily returns. DBMF rebalances weekly, Resolve rebalances daily. So Resolve is bringing in more markets, and it's rebalancing way more frequently. DBI is not just estimating from a 60-day backward looking window, it is then implementing that estimate with up to a week of additional lag on top. Sometimes that lag helps, sometimes it hurts. Resolve's bottom-up systems compute their signals from today's prices and trade on them today, so it catches trends as they happen. When people talk about timing lag and replication, that compounding is the mechanism, and it's why the two funds can hold the same directional view and they still diverge. Now, I want to emphasize again, there's two indices at play here, the SG CTA Index and the SG Trend Index. Neither one is better than the other, they're just slightly different things. You know, The CTA index is a little bit more diverse. It's not only trend following, it brings in things like carry, crisis alpha, long short, some other methodologies to get a little spice of diversification in there. Um, Now, Resolve, on the other hand, which is RSST and RSIT, is targeting the SG trend index. So this is purely momentum and trend following. So it's important to keep that in mind. There's quite a big difference in returns between these indices over certain windows. They do have a lot of correlation, but the way that they choose their constituents is different. And because the SG trend index is more concentrated, it means it's a harder target. It only has 10 constituents instead of 20, and CTA has the 20. And because it only has 10 constituents, that means that there's less cross manager averaging for a replicator to fit against. So the folks over at Return Stacked have actually bitten off a harder chunk to chew when it comes to this replication method. Now, I mentioned that DBMF is much more concentrated. It does its replication across 10 to 15 contracts, and right now it's at 10. And I've put those up in a table. And what's really interesting to note here is what's not present. So the commodity book is two contracts. It's got crude oil and gold. No agriculture, no base metals, no natural gas, no softs, no livestock. The rates book is entirely US bonds, right? So that kind of explains its outperformance and why it's going so much higher than its base SG CTA index, right? Because, I mean, think about all the trading drama that's been going on with the closing of trading routes, oil prices spiking, and the path that gold's been tracing since 2019. If you've got 10% notional exposure to gold and like 12% notional exposure to oil, then that's going to give you a bit of an advantage over a fund that has a wider spread. But that's very contingent and contextual. And it means that DBMF's insane outperformance over the past few years, it's not something that can be expected in every environment. And it's kind of just an accident that the top 10 liquid contracts it went with happen to be ones that are really knocking it out of the ballpark right now. RSST, on the other hand, and RSIT by extension, well, they do the bottom up and top down combo approach here, and they do it with more markets. So a lot wider spread across commodities. Indeed, they bring in energies futures, they bring in agriculturals. Metals represent a much lower portion of their holdings. So that's kind of an explanation right there why DBMF has been performing so much higher than the managed futures sleeve of RSST and RSIT. It all comes down to gold and crude oil. Other thing that I want to point out here is that when you're looking at these charts, sometimes they don't always sum up to 100%, and that's just an artifact of the leveraging that's typically used in these managed futures strategies. And that gold got me to thinking, if you're running a strategy like I do that has a lot of gold exposure elsewhere, DBMF starts looking a little bit less attractive because you're basically doubling a bet that you're making elsewhere in the portfolio instead of doing what managed futures does best, which is to follow uncorrelated trends that you're not already capturing elsewhere. And the difference here is that Resolve, again, the company that runs the strategy for RSST and RSIT, they do a common volatility target before fitting. So a market whose volatility expands gets a smaller weight for the same signal. And DBI's regression doesn't have that constraint, so it can lean into trends a bit harder. Again, its strategy is a concentration bet, which can pay off and certainly has since 2019, but isn't always going to do so. Whereas ReSolve's is a little bit more of a conservative, more disciplined approach. I mean, not to mention the SG Trend Index has historically outperformed the SG CTA Index. So it doesn't really need to take more risks. It's already pursuing a more volatile group of strategies. So the difference here makes sense, but I really want to emphasize what I found shocking was just the sheer breadth of contracts that RSST and RSIT are using for their managed futures allocations. I mean, 33 total and 15 for commodities for RSST and RSIT, whereas DBMF is running a lot fewer. So RSST and RSIT has a more complex, more sophisticated, more broad strategy that can be a good thing. It can also be a bad thing if it gets overcomplicated. I mean, we've talked about Makrodakis here on this channel before. Simple often wins the day. But when you're looking at replication for a managed futures index, the proof is really in the pudding. And it does concern me that DBMF has such a large tracking error relative to its index, even though it's worked out great for investors so far. Um, I just really like to see replication funds, replicate. And that brings me back to the whole fee conversation because in all of the published literature from the folks running DBMF, the constant explanation is, well, it's performing so much better because it gets rid of management fees. Well, management fees are a near constant drift, and constants have zero variance, so that component contributes nothing at all to tracking error. I will grant incentive fees are a bit different. They're convex and path dependent, as I stated before. They clip gains above a high water mark and they do nothing in losing periods. And that tends to compress the index's upside against a gross replicator, and that's a variance effect. So that's true. This component does add tracking error, but it's modest. However, the bulk of the deviation comes down to what's happening elsewhere: concentration, timing lag, or volatility scaling. And the obvious explanation here, because DBMF uses so few future contracts to replicate its positions, is the outperformance is coming from this concentration bet. DBMF's incredible outperformance, it's basically just down to luck. And I gotta say, Resolve is actually the more accurate replicator on the numbers. And so what it comes down to is if you want category beta, um, Resolve is the one that actually tracks the trend followers. Now, it's not going to track the broader CTA universe that DBMF does, but you know, it's good for those of us who want to follow trend. Now, if you don't want beta, if you want DBMF's return and you're attracted to the more simplified, more concentrated bet that it makes, then I think that that's defensible. But I looked at a little t test on this to see if the methodology is significant in producing those bigger returns, and I got a t value of like 1.7 over 35 months. So the jury's definitely out on that. We'll just need more time to see if that methodology is actually the right way to go to get that outsized benefit and have it persist in markets where you don't see gold and crude oil just jumping off the charts. So, talking through theory and going through a PowerPoint presentation is one thing, but actually seeing how these strategies track or don't track their underlying indices, that's entirely another thing. And I want to show you in testful.io. So, I've constrained it right here to just since the inception date of RSST, and Resolve Managed Futures is the how I got that, and I can show you exactly how to isolate the managed futures part of RSST real quick. So you just enter the fund, and then we subtract out the S&P 500 part, the US equities part, and we add back in what we borrowed in terms of the federal funds rate to do that stack, and that'll give us the Resolve Managed Futures sleeve here. So I'll show you real quick. So as you can see, you've got Resolve Managed Futures sleeve right there. Oh, right, duh. I've got to rebalance daily. Here we go. So now things are going to make a lot more sense. Da 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 da. Ta-da! See, now they align perfectly. Anyway, so that's how to isolate the managed future sleeve for the resolve strategy. And if you want to isolate a stack and a stacked fund, you can do a similar approach. You just type in the fund, you subtract what you want, you add back the rate at which you borrowed, and the remainder is what you get. Now, I mentioned that the SG CTA Index, if you just take a negative 1.65 drag, you actually get to DBMF sim. Now, that brings up a question. How do we get to the resolve managed futures? Like, what do we need to do to the SG trend index to get to it and have a valid back test? We can solve that right now. So it turns out that a drag of negative 0.65% is going to get us the closest alignment between the SG trend index and the Resolve Managed Futures sleeve. And the correlation here daily is pretty good, 0.745. Monthly is really good, 0.88. Quarterly is around there. Annual is going to be off because this is such a short time period, so it's going to go wonky. So be careful with that. But this is really a good match overall. And this means that we can do some magic with testful.io and go see my other video about how to backtest AVGV and CBYYX for behind the scenes on how to splice stuff. I'm going to skip some steps in this video. I went ahead and already did a Resolve Managed Futures sim ticker that's going to take the SG trend index all the way back in time, just like testful.io did with DBMF sim. So by having this means we can now use the actual SG trend based managed futures sleeve from RSST and extend RSST back in time. Same thing with RSIT SIM using its own developed international stock sleeve. So we can have RSST SIM now and RSIT SIM now and take them all the way back in time and see how they did. So, yeah, let's do it. So they didn't do half bad. You know what? I'm gonna put the S&P 500 and the total world market up here too, so that you can see just how well these stacks did. So I have to revise my opinion about whether managed futures are stackable. They are. I mean, the proof is in the pudding, and the pudding tastes delicious. So you can see right here, RSST sim, using that stacking approach. It improved the max drawdown from the S&P 500 from 55% to 47%. It's running hotter at higher volatility, which is, what managed futures do. But in both cases, the Sharpe ratio has been improved. The global version of this stack also got substantially above the total world market here. So it did very well. Rolling metrics are solid. You see the stacks excelling exactly where you want them to during periods where equities are lagging. Um, the drawdown reduction is noticeable here, so it's working. And to get back to Felipe's suggestion from the beginning, in my other video on return stacking, he said that I really ought to have tested the correct managed futures sleeve against the DFA Global Fund. And I'm going to do that right now. So this is a 60-40 mix of RSST and RSIT global allocation, and just going to rebalance it annually and compare that to DFA's global equity portfolio institutional class. We can also compare it to the AVGV extended ticker that I created. Again, go check out that AVGV and CBYYX backtest video to see how the magic is made in testful.io. So, oops, wrong ticker there. I've got cat bonds on the brain. All right. We could go ahead and backtest. And look here. So portfolio one, which is that 60-40 mix of RSST and RSIT, does exceptionally well. I mean, exceptionally well. Great max drawdown, great average drawdown, just all around pretty good. Better Sharpe ratio, handily beats both the non-traditional index fund from DFA and the value tilted equity fund here. Just going with combining a raw index with a managed future stack. So I need to revise the conclusions that I previously reported out on with the previous return stacked video. I now am no longer uncertain whether stacking managed futures can work. The evidence is in, and it can indeed work. So, where does that leave me? My employer retirement accounts right now are sitting at about 25% AVGV, 25% GDE, 25% DBMF, and 25% CBYYX. I've talked about how I don't actually really love my gold and equity stack being US only, and because I've got so much gold elsewhere already, namely in GDE, this new revelation regarding ReSolve's managed future strategy has me thinking I could move equities off of gold to get global equities on managed futures. The SG trend and SG CTA trend indices are similar enough, like 0.97 correlation at the monthly and quarterly level, that this shift would not undermine or change my strategy in a way that would hurt my returns. I'd just be moving to a higher volatility version of the same managed futures sleeve, essentially, but with actually more accurate tracking. Then maybe I could stack something else on gold, like TIPS bonds, kind of like I did in the Badlands portfolio. I don't know. I'll probably take a week to think on it. I don't like doing things hastily. One thing I do know is I'm not as comfortable as I used to be with DBMF now that I've seen the full SG CTA Index beyond marketing materials and have been able to go behind the scenes and figure out what exactly I was testing on in testful.io. I mean, look at the divergence here. So this is this SG CTA index, and as soon as DBMF saw its inception, it's diverging from its index quite a bit. And with my strategies, I love to be able to get a good idea of how they've performed in the past across different macroeconomic conditions. And I just don't have that confidence with DBMF now that I've seen how the sausage is made behind the scenes. I mean, it's kind of weird for me to fret about it since it's outperforming its index by so much, but that actually makes me more nervous because it's doing so from a concentrated bet. It kind of takes me back to the same feelings I had during my breaking up with CTA video, where I was like, is this fund about performance chasing, or is it about, replicating a good solid robust index that's going to serve me well across macroeconomic conditions? Now look at, for contrast, how ReSolve's strategy has tracked its index. So this is the SG trend index with a negative 0.65 drag applied to simulate stripping out the management fees. You can barely see the divergence up here with the yellow line for the Resolve managed futures simulation right there, just barely, because it's tracking the index so closely here. And that's really, really attractive for me. And I'm mainly interested in the trend followers in the CTA index. So stay tuned. There may be some changes coming to the Atlas portfolio because of this new information brought to me by Felipe. So thank you very much. I really love the feedback that you give me. And, this is what it's all about, helping each other learn and improve our investing strategies. Thank you for watching Miller Momentum. Be sure to like and subscribe, and don't hesitate to throw good ideas or criticism my way down in the comments. Being data driven in my investing approach means that new data can and does alter and evolve my opinions. I mean, that's the way it should be, right? I'm excited to have learned more about RSST and RSIT and to have cleared away some of my misconceptions about these funds. I'm also really happy I figured out how to get to the SG CTA and trend indices directly. Stay tuned because great things await. Next up, a deep dive into Wisdom Tree's WTIP and GDT ETFs, which involve stacking TIPS bonds on various things. Then, a video about my absolute favorite US momentum factor fund, VFMO. After that, I'll share out possible updates to the Atlas portfolio in view of my new understanding of RSST and RSIT. And I'll catch you next time.